Dr. Babasaheb Ambedkar Open University.
Hello my dear students, I am welcoming you to Dr. Babasaheb Ambedkar Open University in video lecture series for the course BBA Regular in the subject code 202 Financial Management, in that block number 4 unit number 1. The block 4, it's talked about investment analysis and financial planning. In that unit number 1 is mainly focused on your investment analysis. So let us begin our session with the brief introduction and the different learning objective with respect to the investment analysis. My dear student, whenever we study something, we have some in mind. Okay, what are the objective that we are study this subject or study this topic? So let us understand what are the different learning objectives are there. The first learning objective that to you define and you understand the investment and financial decisions, then the components of the cash flows, then the make the complex investment decision. That means you have that much understanding, you have that understand that at which purpose and at which time you will be get some benefits and you take a perfect decision with respect to your investment. Then you distinguish between the free cash flow and terminal cash flow, and then arrive at a net working capital. As we have studied the net working capital in a chapter of working capital, but here you justified with the perspective of the investment analysis or take an investment decision, my dear friends. Now let's begin our session with the introduction point. Now my dear friends, you understand what you mean by the net present value, that is NPV. The investment decision for any firm should be based on net present value. Rule for which we needed the discount the cash flow, as this topic is studied in the capital budgeting also, that what is the net present value and etc. So here just justified that the whole investment decision is ultimately depend on your net present value. The estimation of cash flow is an important step in the investment analysis. A fair amount of efforts in terms of time and money should be invested by the management of a company in obtaining accurate cash flow estimates. That means, my dear friend, whenever the company describe or elaborate the cash flows, at that point of time the whole management is ultimately obtaining the accurate cash flow. Just because of that cash flow, the investment decision and other financial decisions are also taken up on that particular cash flows only. The cash flows are the estimates by the financial manager based on the information provided by the expert of various departments like production, marketing, accounting, economics, research and development, sales, etc. And he is also responsible for the checking the relevance accuracy in that particular information and whether that information is accurate or not, and accordingly the cash flow is prepared or not. Now the main financial decisions are investment decision, financial decision, dividend decisions and working capital decisions. In that, my dear friends, our major focusing on this particular block or unit, that is investment decision. But investment decision is nothing, there is no relevance without financial decision. So my dear friends, we have to understand the financial decision as well as investment decision simultaneously. Now let's begin with that investment and financial decision topic. An investment may be financed by the firm either by the debt or equity, or partly by the equity or partly by the debt. That means we are talking about the capital structure, my dear friends. However, it should be noted that any earnings or proceeds from the debt or equity is not treated as a investments inflows. Likewise, the payment of principal, interest, dividends, etc. are not considered as an investments outflow and hence are not taken into account while computing the investments net cash flow of the company. That means that whenever you are talked about or taking any investment decision, at that point of time, my dear friends, you have to evaluate this different perspective also. And for that, your capital structure is making an efficient manner, and on that basis, you achieve your all goals, etc. Now let us understand which are the different components of cash flows. There are mainly three important components of cash flow, as particularly while we are taking the investment decision or investment analysis. First is initial investment. That means that you have to elaborate and you have to take up the initial investment. Just in a cost accounting basis, we just define that the cost, the amount of cost. So here we talked about the investment decision. That's why here we are defining that is a initial investments. On that initial investment, you get an annual net cash flow after deducting something depreciation, taxation, etc. and other provisions are there. Then you define your annual net cash flow, that is inflow and outflow after evaluating and calculating summation and different aspects are there. So you will be get the annual net cash flow. Then terminal cash flow. So ultimately the whole process to define the net present value, the first concept of our investment decision, that is it is only and only based on that net present value. So you justified it with the net present value of cash flow. Now sir, question mark, sir, how we define that the net present value of cash flow or net value of cash flow? So yes, my dear friends, you have the profit before depreciation and tax, the provision containing under the accountancy system, and you will be get that profit before depreciation and tax after deducting expenses from the income. You will be get this type of particular amount of that, which is treated as a profit before depreciation and tax. In that you deduct your depreciation first. Now sir, question mark, sir, how we deduct the depreciation and which method should be appropriate to deducting the depreciation? So my dear friends, this will be defined in your accounting policies, and in a prior basis your accountant tell to you whether this particular depreciation is treated like on the basis of SLM method, straight line method, or written down value method, or sum of digit method, or annuity method, whatever the different methods are there. So after that you deducting the depreciation, then you will be get profit before tax. In that you defining or deducting the provision of tax, that is the taxation minus tax. So you will be get profit after tax. In that, my dear friends, you added back your depreciation, then you will be get cash flow. In that you multiply it with the different discounting factor or present value factor, then you will be get present value of cash flow. In that the total present value of cash flow, in that you minus your deduct your initial investment, then you will be get net present value with respect to that particular project. So ultimately, my dear friends, for taking a long term decision, at that point of time your investment decisions are the very important, and for that you have to determine the different components of the cash flows also. Now let us discuss the first basic component of cash flow, that is initial investment. The net cash expenditure made by the company during the period in which an asset is purchased by the company is called the investment or initial investment. The gross expenditure or asset's original value comprises of the accessories as well as the spare parts, and also the installation charges form the major chunk of the initial investment. That means कि you added your all different expenses which are relating to your initial investment or gross expenditure with respect to your particular business or investment. So ultimately which is treated as initial investment. Say for example, your initial investment is rupees 1 lakh, and for that you acquiring a one machinery or whatever are that in your company, that installation expenses or the delivery expenses is rupees 10,000. So this will be also treated as your initial expense, so initial investment, so it will be added in the head of initial investment. Original value is considered for the calculation of annual depreciation. In that your expenses are not covered. The difference between the original value and depreciation from the book value of the asset, and also if the assets are purchased with the aim of increasing the revenues, then investment in net working capital will also be required. So the initial investment is the sum of gross investment and investment in working capital. So here the initial investment can be defined as a sum of your gross investment as well as the investment in working capital. Also, in case of the old assets are sold to buy the new one, then the cash obtaining by the selling and old asset should be subtracted to obtaining the initial investment figures. That means that you deduct that particular figures from the books of account with respect to your old assets. Now let us take an example of a manufacturing company, says the ABC Private Limited. Supposing the project requiring the land and development of a site for a building factory, the initial investment of the company would be as follows. The rupees in lakhs. The first point is that is a property and site development 70 lakhs, building factory 900 lakhs, plant and machinery 3630 lakhs, then erection expenses 300 lakhs, then miscellaneous expenditure 250 lakhs, then preliminary and the pre-operative expenses 100 lakhs, contingency 300 lakhs. The total will be 5,550 lakhs. Net working capital is 500 and total initial will be your 6050, that is 6050 is your total initial investment. Now let's talk about the second component, that is net cash flow. Once the initial cash outlay has been done, the investment should start the generating the cash flow. That will be in an efficient manner. Once the cash outflow or outlay has been done, at that point of time the generation of the cash flow in investment will be the faster and moving the faster. The estimation of cash flows should always be carried on the after tax basis. Net cash flows of the company is nothing but the difference between receipt of cash flow and payment of cash, and it inclusive of the taxations or taxes also. Though the net cash flow preliminary consists of the annual cash flow that occur from the investment operation, and any changes in net working capital as well as the capital expenditure may also affect it. And to understand the net cash flow, we determine that is cash revenue minus cash expenses is equal to your cash profit minus taxes, which is treated as a net cash flow. That means that ultimately the we can say the profit before tax, which is after tax, which is treated as a net cash flows. To understand the net cash flows is more detail, let us take in a simple case wherein the cash flow occurs only from the operation. Supposing that the sales, that is your revenue, generated in a cash and payment of all cash expenses in a cash, which is defined as your total revenue, that is sales minus expenses, is equal to your profit. In that you deduct your tax, which is treated as a net cash flows. As in earlier example I treated with the depreciation point also, here we are not considered the depreciation, here we just took up the taxation policies. Okay. Now let's discuss the third component, that is terminal cash flow. In that first point, that is salvage value. The market value of the investment at the time of its sales is called its a salvage value, and is a typical example of terminal cash flows. In this, the cash earnings or proceeds obtaining from the sales of the asset is considered as a cash flow in the terminal and the last year. According to the current taxation law in India, there is a no tax liability on the sale of asset. In case of replacement of the existing asset, the current cash flow will be increased by the salvage value, or initial cash outlay of the new asset will be decreased. The following are the efforts of salvage value of a new and existing assets. The cash flow in the terminal period of the new asset will be increased by the salvage value of the new assets. The initial outlay of the new asset will be reduced by the salvage value of the existing asset, and the cash flow of the new investment will be reduced as a terminal period by the salvage value of the existing asset at the time of normal life. That means the whole terminal cash flow will be depend on your salvage value, and the whole process, which ultimately we can say the affection with the existing asset at the end of the normal life. So ultimately, when we are talked about that, the cash flow of the new investment will be reduced by the terminal period by the salvage value, and existing cash flow, or we can say the existing asset value, will be and it's a normal life. Say for example, the 10 years life is there, then the terminated value is a lower. At that point of time it will be 0. At that point of time your normal life is completed, and your cash flow is also terminated with respect to that particular years. So ultimately we have to define that the number of years, that is your useful life, or we can say the normal life, and accordingly the cash flow will be become a 0. At that point of time your initial investment will be the totally accepted or occurrence with that particular era or area, so it will be defined as a terminal cash flow. Now let us discuss the next topic, that is complex investment decision. Many a times of a company comes across the complex investment situation and need to choose the one several alternatives. In such situation, the usage of NPV can be extended to handle the such complex investment decision. Now question is, sir, how we are defined that this is a complex investment decisions? Whether this is the only aspects for that we define the investment decision will be the complex in nature. Say for example, my dear friends, let us take an example with respect to the COVID situation. The before COVID situation, the business are run in efficient manner, or we can say in a deficit manner or a defined manner. But after COVID, the situation is changed. At that point of time, each and every business aspects have to take a complex investment decision. And at that point of time, my dear friends, you evaluate and you took a complex investment decision with respect to taking an expert decision, or we can say the decision on the basis of your net present value. Whether your net present value is in a favorable measurement or not, which will be defined. And at that point of time, you took a perfect complex investment decision with respect to your business. In that, the first is existing asset replacement. What are the different complex investment decisions? So first is existing assets replacement. The decision to replace an existing asset must be monitored by the necessities and economic consideration. And existing assets must be replaced when there is a availability of more economic alternatives. Normally, many companies approve the new machinery only when the existing one refuses to perform well. In other words, they follows a simple norms of the replacing the machinery only when the old one is totally out of service and has gone beyond the repair. That means it will be not repaired and it is out of service, which will be not useful for your company. At that point of time, you took a decision for the replacing your existing asset or existing machinery. So clearly, it's not the firm who decide when to replace, but the machinery decide to them, and so extremely incorrect and wrong policy of the replacement. Based on the economic consideration, management should decide when it should be replaced. An economic analysis may tell to the company to replace the machinery after 5 years or whatever the defined period are there, but the company replace the machinery says after 15 years when it has gone beyond the repair, then the company is not only incur the extra cost but also lost the extra profit for the 10 years. So there are the two different dimensions are there, my dear friends. First is whether the company's policy for replacing an asset, and second is economic analysis or economic consideration for replacing an particular asset. Say for example, if you buying a car and that the car life is for a 6 year or 5 year, but you continuously working over there and maintaining other different charges are there and repair and maintenance charges are incurred in particular session, and you run that particular car for a 10 years, and after you reaching a 10 years and then you have the no idea and there is a no substitution with respect to your repair and maintenance, at that point of time you sell your car. At that point of time, my dear friend, you lost the profit of 5 years, as well as you not enjoying that particular 5 years in a different manner, which will be the mainly affected and which has a different varieties of the new cars are there. So these are the two dimensions while we are taking the complex investment decision with respect to the company point of view or company's policy and with respect to economic consideration. Is it clear, my dear friends? Now, investment decision under the inflation. For the prudent investment decision, it is always wise to assume the inflation for all the practical investment processes, or we can say the purpose. The inflation should be considered while estimating the cash flow and discount rates also. Since the investment decisions are taken for a long term, and in India or whatever the different developing countries are there, the 2-digit inflation number is common, and hence the inflation should be factored in the decision related to the long term investment. So here we can say the investment decision is also rely upon your inflation or country's inflation. The inflation has an adverse effect on the working capital. Increasing cost like a raw material, more investment is required for a raw material to find the receivables. A wise investment policy take into the account the rising the prices, that is inflation, and this should be considered while taking the capital budgeting decision, or we can say the long term decisions. Next is investment decision using capital rationing. Due to the limited financial resources, the companies have to select the profitable project from the various choices available. There are two types of capital rationings are there. First is internal capital rationings and second is external capital rationing. Now what do you mean by the internal and external capital rationing? The internal capital rationing means the profitable allocation of fund is done. In case of shortage of funds, selection of the project is done on the basis of profitability of the respective project. Say for example, you have a 7 or 8 several projects. In that, you just define that which project is profitable in nature, and your initial investment will be recovered as soon as possible with respect to your payback period. So that will be treated as your initial capital rationing. That is allocation of fund with respect to your profitable nature or profitable projects. Second is external capital rationing. The external capital rationing is all about to mismatch in the capital market. That means there are the companies which are dependent heavily on the debt financing, and so they fear the losing the control if they go for the equity financing, and in this case there are limited choice available for the company to selecting a project. So ultimately which is treated as the external capital rationing. Say for example, assume the amount provided for investment is limited to 50 lakhs. Determine the decision project. Now let us take up the capital rationing situation. The project A, B, C, D, E, F. The amount of investment is 20 lakh, 20 lakh, 10 lakhs, 10 lakhs, then 2 crores are there, 2 crores, 1 crore, 1 crore, 8 crore, and the different aspects are there, 80 lakhs and whatever. At that total investment will be recovered from the 1, 2 and 3 aspect, that is A, B and C, that is total 5 crores. Then net present value with respect to that 15 lakhs. In D, E and F, D and E is a 68 lakhs, we can say that, 6 crore and 80 lakhs, and on that the 4 lakhs are the different net present values are there. So ultimately your capital rationing is depend on your net present value also. So here we define that the base solution, that is D and E, that is a 68 lakhs, that is total of A, B, C, D, E 68 lakh, and F is only for the 80 lakhs are there. So ultimately you determine and divided your capital rationing with respect to different project. First you analyze your project A, B and C, or funding A, B and C. Then you go for the D and E, and lastly to the F also. Okay. So this is what ultimately the capital rationing are there. So under capital rationing, only project A through C, the calling for the 5 crore investment, all through the D and E have the positive net present value, they will not accept it. Now let us sum up with this particular unit. In this unit we had a very detailed explanation for the few of the very crucial aspect with respect to your finance and investment decision. We discussed the different components of the cash flow. We define and discuss the complex investment decision. In that capital rationing are there, internal and external capital rationing with different to the existing and replacement of existing asset, etc. So here you learn about how to determine and how to take an investment decision with respect to the different aspects. So hope you learn well in this unit. Hope you enjoyed this particular session over there. Now, after the sum upping with this, you have to evaluate yourself with definite, the long questions are there. Now, question is about how you define it, whether you are appropriate in that particular unit or not. So here I elaborate the two different long questions are there. Firstly, to determine the components of the cash flow, that means which are the different cash flows are there, and describe the whole complex investment decision in that particular era. So these are the long questions are there. Then you evaluate it with the multiple choice questions also, that also which is available in your book or the study material. So you evaluate it in an efficient manner. And if you want to study more with respect to this particular unit, then you may approach. The different reference books are there, that is I.M. Pandey Financial Management from the I.M. Pandey, ICFAI universities material are there, financial management, and different books of financial management. So hope you learn well in this particular unit. Hope you understand well the investment decision and investment analysis in a different approaches are there. So let's meet in a next session with the next unit. Hope you enjoy this study. Thank you very much, my dear friends.
स्वाध्यायः परमः